Glad to be here with you guys. And today's topic, emerging trends in commodity markets, risks and opportunities. So every few decades or so, an event happens, a significant event that changes global markets and causes a paradigm shift in our economies. So I'm going to take you back to the 15th century when we had the bubonic plague. The bubonic plague in Europe completely changed the economy, the global economy, because it decimated the population of Europe. In some cities, as high as 80%. Yeah, as much as 80% of the population were completely decimated. The lucky ones, about 50% of the population remained. So what did that do? That completely flipped the relationship between labor and capital in favor of labor. We had a lot of people who were working in land as serfdom. So the serfdom economy completely changed, and actually that was the end of it in Europe. And we had a lot of things that we take now for granted. The idea of being able to actually move from one country to another country to work somewhere else. That was not the case prior to 15th century. So in the past 2 years, we had something very similar happened. Actually, two main events. One event was, of course, the COVID-19 pandemic and the effect that that had on supply chain, and also the Russian-Ukrainian war that is still going on. So we have three factors, or three factors that are confluencing together and creating a new paradigm in the commodity trading market. So the first one is supply chain, geopolitical factors, which we're gonna detail a few of them, as well as the inflation and monetary policy and the response of central banks to them. So we're gonna start with the supply chain disruptions. So when COVID-19 happened, if you guys recall, everything stopped, and the importance of that was 70% of the transportation and the freight is responsible for the consumption of a global oil production, right? 70% goes to transportation. So immediately, oil prices tanked, and for the first time in history, we had oil trading at negative $30-something. So that was one effect. The other effect was that we had container backlogs in different ports. And again, the significance of that is it raised the price on so many different products that we have, including commodities. So we used to have the flow of containers coming from China to the US, and then from the US it goes back to Asia carrying grains or carrying fertilizers. So when that got disrupted, we got food inflation. And so everything is connected. And that got governments to think, how can we prevent that from happening? How can we prevent choke points? So then government started to implement policies of localization versus globalization. So this is one of the trends that we need to keep in mind in the markets. So globalization is actually retreating in favor of localization. So we noticed that, for example, oil producers such as the UAE, such as Saudi Arabia, what they're doing now is they're actually building big bunkers in Asia, in India specifically, in Japan, in China, where they can store the oil closer to their consumers. So doing that will completely disrupt the way oil is being traded and will give advantage to oil producers who are able to access these markets. And to be able to access that market, also that brings a lot of geopolitics into the equation. So if a country has friendly relationships, then they will be able to have bunkers. They'll be able to store oil and sell their oil to the big consumers like India. If you don't have good relations, then you won't have that kind of access. So when you have politics kind of interfere in global trade, again, as I said, you get localization in favor, you get protectionism, you get reverse globalization, and you get a lot of volatility in the market. The same thing happened with metals and mining. Of course, technology, when we had the disruption in supply chain due to COVID-19, we had inflation due to supply shortages of like chips, and chips go into everything now, from fridges to cars to airplanes to even like mobile phones and even like PlayStations and stuff like that. So then that takes us to inflation. What happens when you have all these shortages? That's called cost push inflation. When you get cost push inflation, central banks are forced to raise interest rates. And that affects, of course, the strengths of different currencies versus others. Currently, we live in a high inflation, high interest rate monetary policy regime, and that has pushed the US dollar index higher, in multi-year high, and that has a lot of negative effects on countries like Turkey, countries like Egypt, and a lot of the emerging markets, especially Africa. And why is that significant? It's significant because these countries import a lot of their commodities and a lot of their products into the country, especially food. Food security becomes an issue, and that causes a lot of also disruption, social disruption in those countries. And there's an interesting saying by Alfred Henry Lewis in 1906, and he said, the difference or the distance between civility and total chaos is just 9 meals. So 9 meals to anarchy, that's where the famous saying goes. And if you think about it, 9 meals is just 3 days. So, so how are countries, dealing with that? So Egypt, for example, which is the largest commodity importer, especially for wheat, they decided that they're going to establish also silos within the country. So now you have all the wheat that used to come from Russia by ships. Now it actually gets stored in big quantities inland, and that gives a big advantage to Egypt because now they're able to stabilize the prices. So for wheat traders, for example, and oil traders, they need to watch the storage, the local storage and the domestic storage of these countries in order for them to be able to kind of get a sense of where prices will go, especially for big countries like Egypt, because when they go into the market, they do affect the price. So Eurozone, UK, and Japan, recently they have decided that they are going to actually do a 180 on the monetary policy. A few months ago and a few weeks ago, they were planning on raising rates. However, due to less than desirable economic indicators, they decided that they're going to reverse that and they're not going to raise rates. That affects their currencies, and their currencies, of course, especially for a country like Japan that imports almost all of its commodities, that also affects the price of commodities in a country like Japan. Same thing that's happening in China as well. The yuan also is at a 1-year low versus the dollar, and that has a lot of effects for the local demand for things like precious metals, for example. So gold in China today is trading at $70 premium per ounce over London LBMA. And one of the main reasons for that, of course, is the higher interest rates in the US that's making the dollar stronger, that's making the yuan weaker, and putting a lot of pressure on the yuan, and therefore the Chinese are demanding more gold. So, what was that? We wanted to talk about geopolitical issues as far as commodities are concerned. Yes, here it is. So we spoke a little bit about COVID-19 and the effect that happened. One of the things that also are, one of the factors that's kind of changing the commodity trading significantly and probably permanently is the Russian-Ukrainian war. If we take energy, for example, Russia was the #1 supplier of energy to Europe. That's not going to happen anymore. It completely stopped, and it will never happen, at least not in our lifetime. So that has created a complete shift in the energy landscape. Now the Russians are sending energy to China, mostly to Asia, and you have new players coming into the market supplying Europe, such as like Qatar, Algeria, and at the same time, this is kind of, it's coming together with another factor, which is the energy transition, right? So energy transition, because clearly countries are looking for energy independence, and with the geopolitical situation as it is now, that's being accelerated. And they are activating laws to that effect. So for example, the Inflation Act in the US, even though it says like Inflation Act, however, it's directly related to commodities and how the US wants to kind of control commodities domestically, right? Like any other country would want to do that. So the Inflation Reduction Act that it was just enacted a few months ago, that's also going to change completely especially the metals of the future landscape. And it will bring to the US onshore a lot of the metal processing and a lot of the metal mining, whereas that was not the case before. So this is, as far as the climate crisis, of course, in the energy transition, now we're looking at the adoption of electric vehicles. Electric vehicles, it's expected that if the world sticks to the 2% maximum increase in temperature, then by 2040, 90% of the vehicles will be electric vehicles. If that happens by 2040, then we will have a significant reduction in the demand of oil. So currently, vehicles consume about 27% of global, this passenger vehicles, about 27% of global oil production, freight, about 17%, and then other kind of forms of transportation, they consume probably about another 15%. So overall, about maybe 60 to 65%. So by 2040, we're going to have 90% of 65% of the current oil consumption basically almost disappear. So again, if you're an energy trader, or if you're a stock trader who trades in mining companies and oil and gas companies, that's definitely a trend that you want to watch. Also, there's another significant kind of factor that's in play, which is the US energy doctrine that was enacted during Donald Trump's administration. So the US, since the 1970s, they were only concerned with energy security. However, a few years ago, they've changed that from energy security to energy dominance. And that will also create a lot of shifts in alliances, in friendships, and probably will perpetuate a lot of the global issues that we currently have. Finally, we spoke about electrification of the economy overall. We spoke about EVs, but also like we have the wind turbines and the increasing adoption of wind turbines in the electric grid. The importance of that is wind turbines, they use about 4 tons of copper. Electric vehicles, they use 4 times the amount of copper that regular cars use. And they say that an electric vehicle has about 1 mile long wires of copper. So again, the significance of that is by 2030, copper's demand is expected to go up by 600%, and the deficit is expected to be about 1.5 million tons by 2035. So again, if you're a metal trader, that's definitely a trend that you want to watch. Also, we have cobalt. Cobalt is very important for batteries, and there is a concentration risk with cobalt because 75% of the cobalt around the world is produced in one country, which is the DRC, Democratic Republic of Congo, which has a lot of issues basically. So this is basically, I wanted to just conclude by saying that we have all these changes, these factors, supply chain, geopolitical events, as well as the monetary policy. All of them are coming together at the same time, and that's going to cause a lot of shifts in trends of how we produce and how we consume commodities. Thank you.